Good afternoon. Welcome to What Do the New Tax Laws Mean for My Business webinar. These webinar series is part of exit strategy series that Sunbelt Business Advisors offering to our clients. And they're really to inform you as business owners, you know, even if the time isn't right now, it's going to be sometime, and it's best to be prepared and well-positioned so that you can minimize taxes and maximize what you walk away with. I'm Joan Young, the president of Sunbelt Business Brokers, and I'd like to introduce David Sheets, our guest speaker today. Hi, David.
Hi, Joan. How are you?
David, good. David is with Berger Lewis Accountancy Corp., and he has over 15 years of experience in corporate and individual tax, planning, consulting, and compliance. And David is very well thought of in Silicon Valley as one of the top tax advisors for clients in both high-tech and emerging companies. So we're hoping that you're going to learn a few new things that have happened out there. David is going to go over a number of topics. If you have any questions during the webinar, if you would write those in that chat box to the left at the bottom, we will answer those at the end of our webinar. And if we don't get to every question, feel free to call David or myself about anything that we're covering. And the information to call David and Sunbelt will be on the last slide. So David, I understand you want to educate us a little bit on business tax provisions.
That's right. Thanks for the nice introduction, Joan. Good afternoon, everyone. I'd like to jump right into the material so we have plenty of time for questions afterwards. But before doing that, I'd just like to mention a disclaimer. The information contained herein is of a general nature and is not intended to address the circumstances of any particular individual or entity. Although we endeavor to provide accurate and timely information, there can be no guarantee that such information is accurate as of the date it is received or that it will continue to be accurate in the future. No one should act on such information without appropriate professional advice after a thorough examination of the particular situation.
So now you're covered.
Okay. So now let's get started. All right.
Okay.
You know, on January 1st, Congress passed the American Tax Relief Act, which the President signed into law on January 2nd. The Act prevents many tax hikes from going into effect and retains many favorable tax rules that were scheduled to expire. So let's talk about what this legislation does not do. It does not attempt tax reform. It deals only modestly with federal spending. It puts off for another day the issue of the debt ceiling, and it's not the grand bargain we were hoping for. So the can keeps tumbling down the road. Most of the Bush tax cuts have now been made permanent, something the Republican-led Congresses couldn't do, and the Democratically-led Congresses wouldn't do for a decade. So all in all, the bill costs over $3.9 trillion over 10 years compared to letting all the tax cuts expire.
So do you think that's a good thing, David?
Personally, I think it was, you know, the best deal that could have been arrived at that point in time. So I think it's, you know, they obviously waited to the last minute to get something done, and they did, and you know, it, you know, as we'll see through going through the material, that, you know, the impact could have been pretty severe if they didn't do anything.
Okay.
Yep.
So we're going to now get into how it is affected.
Right. So what I'd like to talk about is the business tax provisions that were extended, and you know, so the corporate tax rates were generally unaffected. The top tax rate is still, you know, 35%. The S corporation's built-in gains tax recognition period remains at 5 years. That relates to an S corporation that was previously a C corporation, and then say for a number of years it was a C corporation, then it converted to an S, that if there was any appreciation or any value in those assets at the time it converted, then it would have been deemed a built-in gain. And as long as you don't distribute those assets for a period of time, which originally it was 10 years, then they changed it to 7, and then in the last 2 years they made it 5, and then they extended it as part of this act to 5 years, that there is no built-in gains tax if you wait out and distribute after the 5-year period.
That's going to make a few people I know very happy.
Yes.
That's good.
And so this is a good time right now to talk about types of entities. As you'll see with this last act, that the top individual rate is now 39.6%. So a lot of these flow-through entities, as corporations, LLCs, partnerships, the income flows through to those individual owners. And if they are in a situation where they are at 39.6, they may want to consider converting to a C corporation, and where the top rate is 35%. So it's obviously there's a lot of considerations to be made before doing that, but it is I've just seen this more and more as a planning technique.
Okay, thanks.
The other one is the depreciation and first-year expensing of fixed assets. This was extended favorably, and we'll discuss that. And then also the significant tax credits were extended. The payroll and payroll tax related issues were mostly coming from the prior act, which was the Affordable Care Act, and so we'll take a look at those and see how they impact payroll and payroll taxes.
Okay.
And then lastly, we'll talk about the impact on selling your business. But going here into the depreciation and expensing extended items, the 50% bonus depreciation has been extended, and that's an additional first-year depreciation allowance. So qualified assets include new tangible property with a recovery period of 20 years or less, such as office furniture and equipment, off-the-shelf computer software, and qualified leasehold improvement property. One of the other items that was extended was actually the ability to take qualified leasehold improvements over a 15-year life rather than a 39-year life that was in the past. So that applies to qualified leasehold improvements and related to retail, restaurants, and other qualified improvements.
That's going to affect a lot of people, isn't it? That's good.
Yeah, that one is. And so you have to really look, though, at as if you qualify for it. I have one client that has a restaurant, but the property's owned, the land and the building's owned by his parents. So that isn't a qualified lease for purposes of being allowed the qualified leasehold improvement.
Right.
So he's actually not able to take advantage of the 15-year life on leasehold improvements because of that. So you really have to look at the ownership and see, and look at all the requirements to make sure it qualifies for the 15-year life. Most of the time it does, but it's just these instances where you have a related party, it could impact it.
Mm-hmm.
Okay, so then the other, which was a very nice, and have extended, was the Section 179 expensing and allowing it up to $500,000, and the phase out of it. So if you put so many assets in service during the year, once you go above $2 million, it starts phasing out your ability to use 179 of the $500,000 until you get to $2.5 million, and then you're completely phased out, and you're not able to use the 179. But it is a huge benefit and huge tax planning item for us to look at.
Is this furniture, fixtures, and equipment that businesses have?
It is. It's very similar to the bonus depreciation, the assets that qualify for that, and it does include used property as well. So we're always looking at which one is better for us to use for our clients. Is it the 50% bonus or the 179? And it really depends on the situation of the client. And one thing you would just want to keep in mind, Section 179 and making that election and expensing cannot drive you into a net operating loss. or it cannot increase your net operating loss. So if you are in that situation and you want to take advantage of as much net operating loss as possible in order to carry back or to carry forward, the bonus depreciation isn't limited by net income, and so it's more like your traditional depreciation, the bonuses, and sometimes that'll be more of a benefit that way.
Okay. And then tax credits?
Yeah, so the major credits that were extended was the research credit, and they did that one for 2012, 2013. Over its 30-year life, it's been extended 14 times, and it's Congress just doesn't want to make it a permanent budget item, so they don't make it permanent, so they don't have to include it in the budget after those years. But then, it always gets down to, as a big discussion item in Congress, and then they end up extending it. So it's it's one that I wish they would make permanent, because then it would, when you do planning and you don't have any certainty whether they're going to keep extending it, but they have been so far. And that's a very significant credit, and we do a lot of work in this area with our clients to make sure they can maximize any benefits that are allowed.
R&D.
Yes. The work opportunity credit is one where you offer employment to veterans or other or disadvantaged individuals, and the new markets credit is where they give a credit for investing in community development entities. And then you have the employer-provided child care credit, which they extended as well.
Do you know how much that is for employer child care credit?
I do have that, but not offhand, so I'll have to.
Okay, okay. And any changes for employees that's going on now?
Yeah, so a lot of this relates to the Affordable Care Act, and you've probably already seen it already, where the FICA withholding returns to 6.2% versus the 4.2%. So essentially, everyone has a 2% pay cut for 2013.
Okay.
And then you have the 0.9% increase in the Medicare portion, and that's really the hospital insurance tax, and that applies to wages over a certain amount. So for single individual, it's $200,000, and for married filing joints, $250,000. So employers, they're responsible for withholding on wages that exceed that amount, and so that's where the 0.9% will be a requirement for the employers to withhold on their employees. And so we're looking at a situation where, say it's a husband and wife, and they each work at separate jobs, and they each make $150,000. Well, neither of their employers will withhold the 0.9% because they're not over the $200,000. But when they go and file their joint return, it will be calculated on their return, and they will have to come up with that 0.9% on the difference between $250,000 to $300,000, and so there will be an extra $450 amount of tax on their individual return.
So if they filed separately, then they wouldn't have to?
No, well, you would only get half of that amount then, so they'd only get $125 each if they file separately. Okay. So
okay.
That was good thinking, Joan, though.
I'm trying.
Yes. Okay, and then as everyone's seen, the $2,500 limit on the medical flexible spending. Yeah. Okay. So then, if you're taking a look at selling your business, a lot of times as a seller, you'd like to sell the stock and recognize, capital gain, and then the buyer sometimes they don't want any unknown liabilities. They would rather step up the tax basis in the assets, so they would rather buy assets a lot of times. So usually you'll negotiate, and you'll end up selling assets, and doing that, if you're in a C corporation, that you'll sell the assets and then you'll be taxed at the C corp level, and there is no capital gain rate at the C corp level, so you'll pay the ordinary rates at the corporate level, and then if you dividend or distribute out the proceeds, then you'll be taxed at the individual level. So there is that potential for double taxation.
If you're a C corp.
If you're a C corp, and so that's why a lot of times, you'll figure out, okay, what's the tax impact, and then you'll negotiate it with the buyer to say, here, listen, I'm going to pay more tax this way to get you the assets you want, and you want the step up. Here, let's kind of adjust the sales price here so that you can kind of help compensate me for these extra taxes that I have to pay in there. So it's, but we've had some luck in situations with clients where it's a closely held corporation, and it's really the facts. You have to look at the facts, and it has to sort of match up with what's been allowed in some tax court cases, and one was Martin Ice Cream Company, and so what it allows is that if you look at the assets that you're selling, and some of those assets are intangible, say like goodwill or customer lists or some know-how in there, that you're able to carve that out, and you look and see who's really the owner of that intangible. And if it's a closely held corporation and the main shareholder owner is the main person in the business that's developed a relationship with the customers and developed a relationship with the suppliers, then really that could be considered an intangible of the shareholder, not of the corporation. So when you go to sell, you would sell that directly as a shareholder and pick up just one level of tax, capital gain, on the sale of the goodwill and the other intangibles.
And it's called personal goodwill, right, David?
Yes. Yes. And so there's certain requirements that you have to meet. Well, you can't. In a lot of these cases, you won't have you don't want to have an employment agreement in place that says, here any intangibles or anything is the property of the corporation, or any covenant not to compete. A lot of times will sour it as well, where you have a covenant to compete with your own company. That could sort of kill this opportunity. But but in a lot of these situations we're seeing with just a single shareholder, they don't really have an employment agreement with their own company, and they don't have a covenant not to compete clause in there. So it's actually, they're able to take advantage of the opportunity of saying, this is personal goodwill. And
I've seen it work well for the medical industry, or in chiropractic, where the doctor is what the business is about, and so that is personal goodwill. Wouldn't you agree that medical, or even selling a law firm or an accounting firm, that could be considered?
Yeah, absolutely. The professional service industry, yes, that is. That's where I've seen it. That's where there is another case, Norwalk case, which they were able to win in the tax court and be able to show that they sold it versus their personally versus their corporation. So
and you're saying that can really only be beneficial if it's a C corp.
That's right. That's right. Because if you're a flow-through entity, then obviously it's being taxable to you, but it's flowing through the entity and directly to yourself.
Yeah. So it's going to be capital gains anyway.
Right.
If it's allocated, okay.
Yeah.
And then the installment sales?
Yeah. So the installment sale, wanted to mention that. A lot of times when you do a deal and you sell your business, it's not an all cash deal. You're not getting everything front, or so in a lot of cases you're getting paid over a period of time, and sometimes there's an earn-out in addition to it. So just that as an individual you're a cash basis taxpayer, so you'll just pay tax on that. You're automatically on the installment basis method of being taxed. So you'll pick up the gain as you receive the proceeds. And we're just looking at this last year for people that had sold in 2012. Had a client that sold some real estate in their family limited partnership, and they decided to elect out of the installment method. It wasn't a huge amount of gain on the property, and so they just decided, well, we'll just take the 5% savings now. So they essentially say they're going to be taxed on the whole gain in 2012 versus over a period of time where they would be taxed at the 20% higher rate for those future years.
Okay.
So it's, and then you can structure it too. If you look at the installment sale and look at where you are income-wise and try to spread it out enough where you stay underneath, where you can take advantage of the lower tax brackets, and not fall into the higher tax bracket where you have to pay an extra 5% gain in higher individual taxes.
I think we probably just discouraged a few of our listeners hearing that they're not going to get all cash at closing. I mean, it does happen, but so often if a buyer is doing a small business administration loan, an SBA loan, they might even require that the seller carry 5 to 10%. The buyer will put down 20, and the bank will do the rest. And even if it isn't SBA related, many sellers just really like the idea that a seller is going to say, okay, I'll carry a percentage of this over time. I'm going to get it personally guaranteed, so I'm not at risk of losing anything. But they just feel like that the seller's behind the business. There's nothing he's hiding or she's hiding, and it produces a lot of goodwill in the transaction.
Okay.
David, there was one other thing that I wanted to mention that is something that my husband and I have taken advantage of, and we're associated with a tax-deferred program that helps sellers deal with, the critical consequences of taxes in the deal, and it's really categorized to what's termed a structured sale or installment sale. However, this variation is called a deferred sales trust, which provides just amazing flexibility versus traditional plans. And for example, the seller can receive as much of the sales price as desired, but then put the balance in a tax-deferred investment plan. So we have a seller that's looking at a business that will probably sell for about $5 million. They don't need much from that. They may keep $500,000, but they love the idea that they can defer taxes on the rest of it and invest it in many different vehicles, such as real estate, stocks, bonds, mutual funds, annuities, where oftentimes it's just annuities that you're getting. It's like a life insurance policy. But the one that we're familiar with, that I'd be more than glad to hook anybody up that likes the idea of deferring taxes, of how you can do that. And we have doesn't mean you're going to do it. I'm going to do a disclaimer here, but we have made interest of 10% over the last 5 years on it was a rental, real estate rental that we sold, and we've done very well with it. And you can also receive an annual interest from it if you'd like, but you don't have to. And you can even split up the deferred trust among family members. So if you wanted to give some to your daughter, some to your son, and then you keep some. So there's a lot to explain about it, but if you're interested in hearing more, you can call the Sunbelt office and ask for John Young, and he can hook you up with a company that we've worked with. It works very well because most people like the idea of being able to defer tax as long as you can.
That sounds real interesting.
Yeah. And then you've got individual income tax rates?
That's right. I just wanted to, I think a lot of people have already seen sort of what the rates are, but we do have a little chart here that makes it easy just to sort of understand where where the rates come into play. And so if you look at the the middle there at the ordinary income rates, you'll see sort of where they were before, right up there to the 35% level, and then all of a sudden now going above the 400 for single or 450 for joint, and that's based on taxable income. So this is after your itemized deductions and after all your deductions, where previously the brackets have been based on adjusted gross income or some of these rates here, which is the the capital gain or the earned income and investment income is it's all based on taxable income here. So it's the 200,000 AGI and the 250,000 that relates to the 0.9% that we talked about earlier, the additional Medicare, and then it also relates to this the investment income. So it's it's really when you're looking at when does the capital gain rate goes to 20%, and it's based on a taxable income level, not an adjusted gross income level.
Okay.
So that's to keep in mind. And so just to summarize, individual tax rates remain unchanged except for higher income taxpayers. Capital gain and dividend rates for higher income taxpayers, personal exemption limitations to apply to high earners, and then limitations on itemized deductions for high earners. And then it says here permanent AMT relief, but it doesn't mean AMT's gone away. It still affects a lot of taxpayers.
What is AMT? What is AMT?
Oh, that's the alternative. That's the alternative minimum tax. So it gets it runs sort of simultaneous to your regular tax with the brackets and everything, but certain things aren't allowed as deductions. Say like state taxes, for instance, are not deductible for AMT, and then capital gain rates are equivalent. So a lot of times if you have a lot of state taxes or high capital gains, you'll be subject to the AMT, which is at a sort of a flat rate of 28%.
Okay.
And so what's been going on the last couple of years is that this they have an exemption amount, and it was 78,000, almost 80,000, and then it kept expiring and going back to 45,000. And so Congress would pass a patch and bring it back up to the $78,000 amount, and so then they had to do that for 2012 as well, and then now finally they made it permanent that it's on an indexed basis, and it will stay at that rate. Now, if it would have dropped, that's what we're all concerned about, because for 2012, if it wouldn't have been fixed with this last act, it would have caused 60 million people to be subject to AMT.
Wow.
More than in the past. So it would have had a huge impact. So at the end of the year, we're having to do multiple tax plans for clients. One, assuming they were going to pass the patch. One, assuming they wouldn't, and then let them kind of decide what they were going to pay, or think, or let them be a part of a decision. They were either going to exercise stock options or and how much they were going to sell. So it really complicated the tax planning this last year. But now they did fix it, and they did make it permanent. But it's just not a permanent AMT relief. There will still be people that will be caught in AMT and need to.
Are there still some issues kind of hanging out there that aren't resolved, that you're going to have to still be unsure of next year how to plan for your clients?
Yeah, well, I mean, some of these things are only for a year or 2 years, and then all of a sudden you have to look again, to how it's going to, whether they're going to extend it again, or how are they going to, what are they going to do with, are they going to let things expire again? So it really didn't. saying like early on, this wasn't a this wasn't a overhaul. It wasn't a complete reform here. It was just it really just fixed a few things temporarily, and so it we'll run into a lot of these things.
Is that why you're referring to the AMT relief as a patch? It's not for sure forever?
Oh, no. Well, that part is. And that just relates to just that exemption amount. So
okay.
The exemption amount went from where it was going to drop to $45,000 of an exemption, which would have caused a lot of people to be subject. It made that permanent at $78,000 and indexed for inflation. So it will adjust year after year, but it will adjust upward.
Okay.
Most likely. So it will. So that's what the relief was. It no longer we have to worry about. Oh no, it's going to be 60 million people who are going to be subject to AMT. We don't have to.
Okay.
At least from that point of view, we don't have to worry about that one. That one was a permanent fix.
Okay. And it looks like there's some other changes.
Yeah, and so there's. The other changes is, well, the one I mentioned earlier was that payroll tax holiday expired at 2%, and then just the individual had to pay the Medicare tax on the unearned income, the 3.8%, and then Roth conversions, they extended that where you're allowed to convert your 401k, your current 401k into a Roth, and then the good old Prop 30, which is related to California tax increases that come in over the California bracket, and goes up to 12 points.
Can you go into more detail about what you're referring to for those who might
not? On Prop 30. Yeah. So Prop 30 was essentially what they did was they raised the sales tax rate 0.25% for 4 years, and then and then it's retroactive too, which is they impose a rate of 10.3 on taxable income between $250,000 and $300,000, 11.3 rate over 300 but less than 500, 12.3 on income between 500 and $1 million, and then 13.3 on above 1 million. Which this is for 2013. I think for 2012, I believe it's capped at 12.3, and it's effective for 7 years. Essentially, these increases. So it's really it's on the top 3% of Californians. Essentially, what they're saying is the impact on these additional taxes.
I didn't know those brackets. So thanks for going over that. And then let's see. You wanted to give us an example of Phil Mickelson?
Right. So Phil Mickelson, the professional golfer. In the last couple of weeks, he's been in the news, and what I've noticed, from the couple times he's been quoted or been in the news, that he hasn't been very good at estimating things. So just like this last weekend, before the weekend started in this golf tournament, he said, my golf game is just a fraction off, and then he ends up tied for 51st place in the tournament. So I think he was a little bit more than a fraction off. And then I just wanted to say, well, then also before that, he had commented about his, what his total combined taxes are that he pays or will pay with Prop 30 and then the increase in federal rates. So I wanted to just kind of go through and see how he did estimating on his taxes. And so he's estimated to earn $61 million, and he says he'll pay 62 to 63%. So if we add it up, we're looking at 39.6, for federal above, 450,000 of income, 12.3% for California on income above 1 million, and then the 1% California mental health surcharge on income above $1 million, and then there's the 3.8% Medicare tax on earnings above 250. So, one thing he didn't consider is that the state tax that he pays is deductible. So I don't think he factored that in, even though there will be some limitation because of how that phase out of itemized deductions works. So he won't get full benefit of it, but he will get some benefit of the state taxes that he pays. So if taking that into consideration, so you come up with a total combined rate of less than 53%. And so I'm not sure where he got 62 or 63. I mean, maybe he added in his FICA, but that's only on income up to 113, 115,000. So I just think that I think he kind of missed the mark on estimating on his taxes as well. So he just needs to take, I think, a closer look at his return, or get another CPA. I don't know.
That's good. I think what I'm hearing too is that planning is important, and if anybody is considering selling their business in the next few years, I think working with you or their accountant to be able to plan whether they're in the right entity. Is it best to say as an S? Should you switch to a C? And how much tax that's going to affect you, and how you could allocate that purchase price so that you do minimize the taxes going forward.
That's right. That's right. And a lot of things will be considered is are you going to use the tax money that you're saving if you do convert to a C corp, using it in the business and helping you to grow the business, and then also is there any assets that are going to increase in value that are appreciable assets, and potentially that may not be a good thing to have in a C corporation.
Right.
So it's because of the double tax, because there's no capital gain rate within the corporation tax so there's a lot, and there could be some legal reasons or non-tax reasons for that just need to be considered before doing that. But it's but I've seen it in a few articles already this year as far as this is something to look at and really consider for this year.
Okay. Well, I know most of my buyers that are looking at investing in a business, they really do prefer an asset sale, where the seller, if they're a C corp, of course want to do a stock sale. But it's tough to convince the attorney and the accountant of the opposing party to go that route, because it makes such a difference to them. And like you said, the step-up basis of if it's a lot of machinery involved in the business, if there is none, then it really doesn't matter that much, except for the liability that they might be assuming, right?
That's right. That's right. And yeah, we've had one where had a they signed the agreement with the seller before running it by any an attorney or running it by us, and we looked at the deal, and it was just so one-sided toward the seller, and they were and so we ended up looking at it and because everything looked like an asset sale, but then at the last minute the seller had changed it over to a stock sale, and so our client was the buyer, and when I started looking at it, saying, well, listen, you're not going to get any step up in these assets, you're buying stock, and then we really had to scramble to get them out of that deal, and the one thing that helped us do that was this personal goodwill, and being able to advise the seller that a lot that he was selling was that the intangible of from his because it was a closely held corp, and that he would be able to so we did a little research for him. We showed him where he could apply those tax court case back to his situation and be able to do an asset deal and still come out without double taxation.
Good.
And so
we have a question, David. What were the thresholds for the California tax rates? Was that on the chart, or was that? I don't think so.
No, that wasn't. That was all federal on that one there. But
okay.
But this is 250 to 300 is a 10.3 rate, and then 11.3 over 300 but less than 500,000. and then
okay.
12.3 on income between 500,000 and $1 million, and then really the that 13.3 rate on taxable income above 1 million. But that includes that mental health 1% rate in there. So
and then if the tax rates in California, another question, if the tax rates in California are retroactive to 2012, are there retroactive penalties?
No, California they will not penalize based on the retroactive rate changes.
I would hope not.
Yeah.
Okay.
You always have to ask because you never can be certain with California on what they'll do, but that one is there as well. So one other thing that's recent for California, since we're on topic, is that the qualified small business stock for California doesn't apply anymore. So
and what is that again? I'm sorry. What was?
So before, California would give a benefit if you invested in a California company, and so it was California qualified small business stock, and you'd have to complete a form from every investment for every investor, a form 3565, and then they would use that and they would file that with their individual return, and then later on when they sold the stock, they could possibly roll it over to another qualified small business stock without paying gain, or they could pay 50% of the gain in California. So this has been around since I think it was introduced in the late 90s, and so then recently it's been challenged and deemed unconstitutional. There's no. Now it's anyone that has taken advantage of those in the last 2 years will need to file amended returns in order to those benefits, and there's really no need to file that Form 3565 anymore since the benefits don't apply anymore.
Okay.
Yeah.
Well, I'm looking. I don't think I hear. Let me see. There's one other question. If Section 179 is in excess of NOI, can the balance be carried forward?
Yes, it can. It can. So Section 179 carryover. So that amount. So say, you have 100,000 of Section 179, but you only 20,000. It gets you to an NOL. So you have 80,000 of it that would carry over to the next tax year. Yeah.
Okay, good. Well, we really appreciate you joining us today, David. It's been a big help, and if anything else major happens, let us know, and we'll let our group that came on today know about it.
Oh, yeah, and then you had a question, Joan, on the employer-provided child care. I'll just mention that 25% of qualified child care facility costs plus 10% of the resource and referral costs. So it's
okay.
That's provided child care.
That's for companies that offer any child care?
That's right.
Okay. Well, thank you again, and thank you, group. We will be, I think it's going to be the end of February, our next webinar, and we'll be sending you an invitation. But everybody enjoy their evening, and thank you so much again, David.
Oh, my pleasure, and any questions, please feel free to send me an email or give me a call. I'd be happy to help. And thank you, Joan.
Thank you. Take care. Bye.
Thank you. Please stand by.